What's up, guys? It's Devin Burr, aka Mr. Burr. A lot of you guys have been asking me to make some YouTube content so you can have more in depth material about how the infinite banking process works, real estate, all that kind of stuff. So, this is my first video, guys. I've actually got another video on YouTube, but it's just a spoof music video that I made last year about the Burr method. So, go check it out. You might get a few laughs. But hit the like button and the subscribe so you can get notifications when these videos come out, because I'm going to start trying to put more of my stuff on YouTube so you can get longer explanations and you can learn more from me. So, what we're going to talk about is the infinite banking concept and how that works. Basically, it's a way to become your own bank. It's a savings vehicle that you can use to mimic what the banks do. And first, you need to understand what banks do. Banks, they view deposits as liabilities. So when you put your money in the bank, that's a liability to the bank because the bank then has to pay you for that money sitting there. They don't pay you a lot, but they still pay you. So it's a liability. What they do is they turn that liability into an asset. And how do they do that? They do it with loans. That's exactly what the bank does. They loan your money out to other people. Those people pay the loan back with interest. The money comes back to the bank. The bank then loans it out again for something else. The person that got the loan pays the bank back with interest, and it just keeps going. And it's your money that's being used. And again, the bank is doing it because if they loan it out, if they make a loan for it, it is considered an asset because then they are getting paid. If money comes in, it's an asset. If money goes out, it's a liability. So that's what you need to understand first and foremost is that the bank uses your money as an asset by lending it out. Now, you can do the same thing by using a vehicle that's been around for several hundred years. This vehicle is used by all the extremely wealthy people. It's used by Tony Robbins. It was used by Walt Disney to create Disney World and Disney franchise. Or I shouldn't say franchise. It was used by Ray Kroc, who used it to franchise McDonald's. So it is something that's been around for a very long time, and you can use it to become the bank and leverage loans to make more money. So basically, what it is a high cash value whole life insurance with a mutually owned company that pays dividends. And the policy has to be structured correctly. It's not just your regular, go to your insurance company and buy a whole life policy off the shelf. It's not going to work for that. It has to be specifically designed and structured for cash value, not for the death benefit. And that's important because when you put money in, you're creating a banking system for yourself. The money goes into your banking system or your whole life insurance policy, and it actually makes compound interest guaranteed. 4% interest is the guarantee. So your money will grow for you for the rest of your life, guaranteed. Plus, you'll get dividends based on the insurance company's profitability. Over the last 20 years, it's been about 2% is the dividend payout. So effectively, you're making about 6% on your money, compounding. So it's just going to keep getting bigger and bigger and bigger. So you put 10,000 bucks in. If you make 6%, then you make $600 on your money sitting there. So the next year, you're earning 6% on $10,600, which is then going to make more interest than it made before. And it's just going to keep compounding. And the longer you have it, the more efficient the compounding gets, the bigger the compounding is. So you can put your money there. It's a savings tool to compound your money at a guaranteed interest rate. Then what you do is you use your money as collateral. So your money sits in the policy, guaranteed to grow. It is collateral to go borrow the insurance company's money. That's important because you're doing what the bank does. You're using leverage and using loans, other people's money, to go make money. Exactly what the bank does. The bank uses your deposits to go lend it out to other people to make money. So you can do the same. You just have to fund a policy, has to be structured for high cash value. Then you can immediately immediately borrow from the insurance company's money using your money as collateral. Then you take the insurance company's money that is a loan to you and you go use it to go multiply it. You go do a real estate deal. You invest in stocks. You pay off debt. You, I don't know, buy shoes and resell them. Basically, the possibilities of it are endless. That's why it's called the infinite banking concept. But what you really need to understand is what's happening. You are putting your money into a vehicle that is guaranteed to grow for the rest of your life. You're borrowing against your money because your money is collateral, it never moves. You borrow the insurance company's money, you use that to go make more money while you're still growing over here like you never touched it because it never actually comes out. It's sitting there as collateral. The beauty of it is all the growth over here is tax free. So, again, the longer you have compound interest, the more you make. So, doesn't matter how much you make in compound interest, it's all tax free. So you're getting tax free growth, it's tax sheltered, guaranteed. You can use it by collateralizing your money, use the bank's money, or I'm sorry, the insurance company's money to go make more money, all while it still sits there and grows for the rest of your life. Now, if you're becoming your own bank, you have to be an honest banker. If you go use the insurance company's money, and let's say you make a 20% profit, what you need to do, I shouldn't say need to do, what you should do, you don't need to do it, but you should take your proceeds, pay back the policy loan so that you have all your cash value back. Now you've made your money, the 20% or whatever it is, and you have all your cash value back to use again and again and again, but you don't have to. You see, when you get a policy loan, again, your money isn't touched, it's collateral. You're using the insurance company's money. When you do that, all it is an advance of your death benefit. So let's say you've got $100,000 in cash value. You take all that out and go use it, and you never put it back in there. When you pass away, your beneficiary will get your death benefit minus what you did not pay back in policy loans. So it's just an advance. That's all it is. You should want your beneficiary to get the full death benefit. So be an honest banker, use your money as collateral, get a loan from the insurance company, go make more money with it, pay back the policy loan so you have your full cash value. And if you pass away, your beneficiary gets the full death benefit, which, by the way, is tax free. It's amazing. This is a tool that has been used for a very long time. It's been around for several hundred years. It's been around since before our tax code was enforced, which I believe was 1912. So, guys, this is the secret of the wealthy. This is what they do. They put a lot of money into insurance policies to shelter against taxes, to be able to use the money now, it's liquid, and be able to multiply it. Make money here while you go make money here somewhere else. And you can do a ton of stuff with this. So that is basically the gist of the infinite banking concept and how it works. So go ahead and shoot some comments and let me know kind of what you guys want to know more about. I'll make videos, like I said. about this concept, about how everything works. I can go into really anything, guys. I've been using this concept on a daily basis for the last year. I am very versed at it, and I use it. So the bottom line is, I'm not preaching something that I don't actually use. I use this, I understand it, I know how it works. It's actually made it to where I personally have been able to quadruple my net worth by using this. And realistically, guys, all you're doing is you're just changing where your money goes first. That's it. That is it. Your money first goes into an insurance policy that pays you dividends with a mutually owned company. You can then use it for whatever you usually use it for, all while you're still growing like you never touched it. So, guys, this was my first YouTube video. Hopefully, you got some value from it. Go ahead and shoot some comments. Let me know what you guys want to know about. And if you didn't, hit the like and subscribe. I would appreciate it. That way, you can actually get these notifications when the videos come out. So, I'm going to be trying to put these together as much as I possibly can for you guys so I can bring you more value. Appreciate y'all. Love you. Peace.